Hello, everybody. Welcome, all my Opendoor investors and soon to be Opendoor investors. If you're thinking about buying some shares in Opendoor, today we're going to do something special. We're going to do something we never did before. We're going to compare Opendoor Technology to Carvana. We're going to find out why is Eric Jackson saying Opendoor can do the same thing as Carvana. We're about to find out right now. So I'm going to show you a couple of charts, and I'm going to show you some news, and I'm going to show you their similarities of how they are almost identical. Check out this chart I'm about to show you right now. All right, we're going to be looking at the monthly chart. And here's the monthly chart for Opendoor, and it looks, looks pretty great. I'm going to draw a line real quick for you and put it just like that. Just like that. There's a line for you right there on a projection that we want to go. We want to go just like that in that angle. It looks good so far. This is the monthly chart for Opendoor. I put monthly so you can see what happened in the past. Now, I'm going to show you Carvana. I already drew the lines on there for you, so check it out. Here's Carvana. Carvana went to $3.55. But before that, we had this long downtrend because of the pandemic. So that's similar to Opendoor. Here's a long downtrend for an Opendoor, and it never could come back because of the housing market. This right here was the pandemic area where I went down, and this right here is the housing market that's been failing for the past couple years. So we had the downtrend for Opendoor during the pandemic, and here's the downtrend for Carvana during the pandemic. Now, here's where things get interesting right here. So Carvana was at $3.55. Opendoor low was 50 cents. So if we can follow the same pattern as Carvana, that's what we're looking for. The monthly chart, as you can see, the first two candles on monthly chart are green right here, and we have two green candles right here. So if it was the same pattern as Carvana, we would be looking somewhat like this pattern right here, which would be the beginning for Opendoor. But like I said before, no pattern for a chart is always the same. Every stock always have a different kind of pattern on its way up. Now I'm going to show you the interesting part for the news. Now this is what I like right here. This is very interesting. May 5th. I chose May 5th for a reason. May 5th, 2023. And let's look at the chart. May 5th, 2023. That is right about here. That's the beginning of Carvana's run. That's the beginning. Carvana had good earnings and a short squeeze, just like Opendoor is trying to have right now. But let's look at the news for Carvana. I'm going to show you this. This is very interesting. Carvana shares soar on upbeat forecasts and a short squeeze. That sounds very similar to another stock. That sounds very similar to another stock, what we call Opendoor Technology. A upbeat forecast and a short squeeze. Now, how do we get like that? Like Carvana. Same thing. We need an upbeat forecast and a short squeeze. How do we get an upbeat forecast? Well, that's pretty much the interest rates need to lower. And then our earnings needs to show better than expected. Now, if you get better than expected earnings and a good guidance, then you have a short squeeze combination. And that's how you get the Carvana chart for Opendoor right there. That's the recipe. That's the blueprint for Opendoor short squeeze chart right there. Now let's look at the meat of the article right down here. Carvana shares soared as much as 55% on Friday after a struggling online used car retail surprise second quarter profit forecast caught bearish investors on the wrong foot. That sounds like another story that's trying to happen right now. A struggling online used car retailer. How about this? A struggling online housing retail. Carvana surprise second quarter profit. Now, if Opendoor can surprise on their quarter profit, they can catch bearish investors on the wrong foot. It almost sounds like the same story. If it can happen, it gotta happen though. It gotta happen. Carvana endured a turbulent 2022 as a company struggled to offload used cars. If you've been following Opendoor, this sounds very similar. It sounds very similar. You can just add it. You can just substitute a few words, and it sounds like Opendoor. Let's say this: Opendoor endured a turbulent 2022 as the company struggled to offload houses purchased at a higher price during the pandemic due to weak demand over affordability concerns. It's the same thing. It's the same thing. Now we're understanding where Eric Jackson's head is at. This is why, right here. These are the articles. This is proof. This is the blueprint. Short positions in Carvana were at $488 million, with short sellers estimated to have lost $142 million since the stock started trading higher and after hours trading on Thursday. So Carvana had a short squeeze with a combination of a growing company. So you have a growing company and a short squeeze together. That's how you get the 82, the 100, the 300, the $500 a share price when you have a good company and a short squeeze combination. That's it right there. Let's read a little bit more because this is very interesting. Some short sellers will add to the buying pressure as they try to close their position. That's called a short squeeze. And therefore causing a short squeeze. Okay, I just said it, but he said it too. Let's go down below, which sounds similar to Opendoor as well. Analysts, however, were still cautious. Same like Opendoor. Analysts are saying the same thing. Analysts are cautious because we don't know what's going to happen. It could go up or down. In this case, Carvana, it went up. This stock isn't for the faint of heart. Given ongoing solvency and a very real risk of macro deterioration. Piper Sandler, analyst, said in a note on Friday as they bumped up their price target on the stock by $1 to $21. There we go. Price target upgrades. That's what you need too. We need quarter profit forecast to be bullish. We need some upgrades. And we need the interest rate to drop to relieve stress on Opendoor. That's a recipe for a higher price per share and a short squeeze. Now, how do we do that? I'm going to show you this right here. Key factors for Opendoor growth. There's two right here. Lower mortgage rates. Opendoor business is highly sensitive to interest rates. So there you go. Interest rates drop down. Opendoor is going to fluctuate a lot because it just says it's highly sensitive, which directly impact home buying demand. The Federal Reserve rates hike in 2022 contributed to a significant market decline that hurt Opendoor inventory. So now we're kind of, we're flipping the switch. We're going in reverse because their interest rates are lowering, which is going to help Opendoor significantly. Falling rates would boost the housing market and increase Opendoor sales volume. Recent Federal Reserve comments indicating potential rate cuts have already sent the stock higher, and that's what we had on Friday. The last point, and it says the stable housing market, a less volatile real estate market is crucial for Opendoor algorithm based on pricing. Stability allows the company to accurately project the value of homes, reducing the risk of being stuck with depreciating inventory and massive losses, as was the case in 2022. There you have it, everybody. So I just wanted to share that with you because a lot of people are wondering, how come you compare Opendoor to Carvana? There you have it. There's proof. And, Opendoor just need to find the right CEO to follow the Carvana's blueprint. And I think we got a nice winner, everybody. A nice winner. So, yeah. Thanks for watching. Subscribe, like, and comment. If you want Opendoor to go higher, you like the information I'm giving you, and you want it on a daily basis, go ahead and subscribe to this channel. Subscribe, like, comment, and more information will be coming your way. Take care, everybody. Have a great weekend.